Welcome to the Business Trendsetter podcast, where we talk about trends and how to grow your business. My name is Manny Turan.
And I'm Adam Hartung.
We're here every week to give you some insights about what's happening in the world as it pertains to trends. And we talk about 5 big trends: AI, the gig economy, asynchronous life, mobility, and demographics are all tied. There's a bunch of other ones, right? And one of the things that's interesting about what's happening in the business world is kind of tied to a couple of those: the gig economy, asynchronous life and work, mobility, and demographics, all tie together. And that is, of course, people going back to the office. There's lots of big companies that are requiring their employees to come back to the office. There are some that are keeping things the same. And there's even another group that's actually closing down their operations, and everybody's working remotely. So the one we want to talk about today is the one that has to do with people returning back to the office or not, and what the implications are for the commercial real estate and thus the banking world. So Adam, I'm tossing you this ball. It's a fast ball. Let's see if you can hit it.
Okay, well, I thought last podcast we did, it was a lot of fun to talk about how the workplace was changing and how the boomer generation was already well out the door, and that workforce practices were going to change pretty dramatically. And if you didn't step up to it, you would hurt. But if you did step up, it gave you an advantage in terms of hiring, in terms of retention, and all those good things. And so following through on that, I did a little more research, and there's a bank called Adam Bank out of the UK. And they took all their employees and they said, look, we're going to put you on a 4-day work week, and we're going to keep the pay the same. In other words, we're not cutting your pay 20%, we're cutting your hours 20%. You're going to work 4 days a week. So it's not 40 hours crammed into 4 days. It's literally a 4-day work week. And they put that in place. And what they saw was that their retention stayed high, their productivity went up, their need to hiring went down because they kept their people longer. The scores that they got on a glass house type scoring, where people talk about good place to work, went way up. They started getting better applicants, even though they had fewer jobs. So all these kind of good things happen. Now, at the same time, Jamie Dimon of J.P. Morgan Chase gets out on television and the newspapers and gets himself quoted saying that everybody's going to have to come back into the office or they're going to pay a price. Really very threatening about the whole thing. Well, here's Jamie Dimon, who's like 67 years old, right? He's a number one banker in the world. It's the largest bank in the United States, J.P. Morgan Chase. And it just shows that in some ways he's just really out of step with where the world is. And his thing is, I want to get everybody back in the office. And what he's demonstrating is this bias, right? That his bias is that people have to be in the office or I can't know that they're working, which obviously is going to millennials and Gen Zers that are working for him. We're going to start looking for somewhere else to go. They'd rather go work for Adam, right? So the whole movement towards fintech and the digital banks and away from the traditionalists will continue to be good, right? So that's a really important factor. But I really wondered about this, people working from home, people working 4 days. And I've noticed, so many people that I know don't go to any office anymore. So I started to dredge up some statistics on this. And, it's true that there is a lot less real estate needed. In Manhattan, for example, take the borough of Manhattan in New York City, office vacancy rates in March. So as of May, we've had 13 consecutive quarters of growing vacancy rates. Now, vacancy rate means that the space is for lease. So the people have left and it's empty, and that space is now for lease. It's listed as for lease. It's 13 consecutive quarters. The amount of space has continued to increase being for available.
That's even right before the pandemic, right? We've talked about this before, that the pandemic only accelerated these trends, and it was already trending in that direction.
It was started going in that direction because, as we pointed out when we wrote Thrive to the Future, work from home and people working gig jobs, that is already a trend, and it would be accelerated in the pandemic. And that's what we predicted, and that's exactly what happened. But look how fast this happened. In March, the vacancy rate in Manhattan was 16.1%. By May, it was 17.4%. So, now what's happening is
4 points.
Very, very few people are leasing space, but people are leaving space, right?
Yeah.
So then I learned that nationwide in March, the vacancy rate was 16.4%, but in May, it was 20%. 20%. So if you take the whole nation, it's doing worse than Manhattan is doing.
That's crazy.
Right? Now, The other interesting thing is that if you go to lease space in an office building, it varies quite a bit depending on where you're located, but certainly in the larger office buildings and certainly in the skyscrapers and those kinds of things, they really push you on a long-term lease. You're not going to walk in there with a 1 year lease. They're not going to do build
We
outs.
want 10 years usually.
Yeah. So what they do, the number one lease term is 10 years, and a short-term lease is 5, and there's a few threes, but most of them are 10. So what you end up with is if somebody during the pandemic said, hey, people working from home, I don't need this space. I'm going to clear out half a floor here. But the lease is still in place, say for another 3 years. They have to keep paying the lease. They're like, we're going to cut our losses. We're not going to pay for air conditioning and heating and janitorial services. People want to work from home, so we're going to cut our costs. But we can't get out of this lease, and we'll tell the landlord, please find us a lessee if you can. But the landlord's not going to do anything for them because the landlord's already got a bunch of lease space available, right? So they have to keep paying the lease. So it doesn't go into the vacancy. So they actually track use. And the way they track usage is they'll say, okay, people that have said I've left the space, told the
Hmm.
landlord they were gone. And the second way is most of our big buildings these days, you can't get into them without swiping a card.
Yeah,
So
like
if you're an employee,
magnetic
you
keys,
swipe
right?
the card. Yeah.
Yeah.
If you're a guest, you have to fill out a form, you get a card, you get to swipe, and you get in. So they actually track the employees and how many employees are using the office space. And that was fascinating. It turns out that in Manhattan, use is only 49%. 40, so half of the office space in Manhattan was empty. So then I started saying, well, what does this do in other markets? Okay, the in San Jose, California, the use rate is 37%. In San Francisco, it's 41%. And
That's
what
remarkable.
that's telling us, yeah, it's tech companies, right? So
Yeah.
the more you can do your work from home, the more you are doing your work from home, the more we've got all this empty space sitting out there. And this is really phenomenal and means important. First of all, you need to understand your statistics, like digging through not just vacancy rates, but what does it really tell us? Because if you look at retail, for example, the retail vacancy rate is 6%. But you think about it for a minute, and say that doesn't make sense. Look at all the empty shopping malls I've seen, and look at all. I go by a strip mall, and
Yeah.
there's 1/4 of them. So empty. Well, why? Well, that's again because it's not doing the use data; it's doing the vacancy rate data. And so, if a mall closes down, then they just take all that out of the statistics. So all those closed shopping malls are sitting there gathering bats and guana are
Right.
not in the statistics anymore. So you can't say, oh, retail's doing great because it's only 6% vacant, when in
Hmm.
fact, the use rate is now down below 50% as well in retail. So
I
we
did
have
a little
all,
I did a
yeah,
little drive around town, and I looked around for commercial spaces and kind of seeing what's being built, and some of the office buildings that they have a vacancy sign out front and so forth, available space. And the majority of what I've seen around Tucson are giant logistics centers being put up. That's 95% of what I've seen,
yeah.
and a handful of coffee places and that kind of thing. But the majority are these logistics company, like Amazon and so forth. And then the office spaces that I've looked around, they all have vacancy signs. They all have, if you want space, contact this person. And so it's going to be interesting what happens in the next 3, 4, 5 years with the commercial real estate world, even this year.
Yeah. And so let's take that other peeling the onion back again, trying to understand trends, understand what the implications are. So now if I had a work area, it could be a vertical building in a city like Tucson or Phoenix, or it could be a cluster of offices, do office clusters, there's an office area over here, 2-story buildings, 7 buildings inside that area. Well, what do you get around that? You get coffee shops and you get luncheonettes, right? And you get breakfast shops and you get after hours places where people meet for cocktails and have conversations at the end of the workday and take clients, and hotels and that sort of thing. Well, what's happening now? So that we call that storefront retail, right? So storefront retail, not in a mall, not in a strip mall, it's a storefront retail sitting in some environment. So storefront retail is now 20% empty in the United States. 20%. Now that's really kind of a hardship because most of your storefront retail, well, not most, there's quite a bit of storefront retail that is entrepreneur owned. Yes, Starbucks dominates in coffee, but there's independent coffee shops, and yes, there are certainly franchises that do breakfast and luncheonettes and that kind of thing with coffee and drinks, and even the sort of Chili's and the other franchises that do evenings. But you can sit there and think about driving around Tucson. you see a lot of places that are, employee owned, right? So
Yeah.
like, wouldn't your mother or your grandmother have a restaurant?
Yeah. My whole family's had restaurants.
Yeah.
Absolutely.
Well, what's happening is now that when people went to the office and they'd say, "Oh, let's go get lunch," well, they'd go to your mom's family, to the place and have a nice lunch. Well, if they're not going to the office anymore, they're not going out to have lunch
Right.
anymore. I don't know what, if they're making a
Well, they're
mac and
making
cheese.
it. Or what happened to me today at lunch is I went to a, sandwich shop here that had just opened about a month ago. Tiny place, had about six small tables inside, and they had a bunch of people working the back. I mean, there was probably eight people making sandwiches. And the time I was there, I actually ate my sandwich in the restaurant. There was six people who came in for pickup.
Yeah.
I was there for maybe 15 minutes. It was a pretty fast lunch. And of those six people, the guy asked each one of them, "Is this meal for you, or are you picking up for somebody else?" Because if it was for them, he would ask them a question about what they wanted for side or like condiments. And it's very interesting that the amount of traffic that they were producing, the majority of it was to go, because there was six tables, we were all occupied,
Yeah.
six people came in and came out. It's pretty
Yeah.
incredible.
Well, and it does imply that if you want to be in the restaurant business, which I'm glad people want to do that, then in the old days you had to have tables for people to sit. You had to have waitresses to serve them, and that's you don't expect that anymore. I'm not saying it's all going away, but the trend is you're fighting a trend because every year fewer percentage of the workforce is working in offices. We're now seeing that percentage is big enough that we had this big move out during the pandemic that aren't going to go back. And just a further testament to that, remember when we had this whole thing about the labor, what do you call it, the labor workforce or labor force, um, oh gosh, I can't read my own handwriting, participation. Remember with the pandemic, we had this thing, the labor force participation went down.
Yeah.
And so that was why, productivity numbers were skewed and all this. And when are we going to get those people back to work? Well, the reports came out this week that we've recovered now, that
Hmm.
we have the people back to work. So we went through people not working in the pandemic. Then we went through the great resignation, remember,
Right.
which was a lot of millennials and Gen Zs saying, I'm not going back to the office. So yeah, we had the great resignation, but now we've had companies come back in and say, I'm going to pay more or I'm going to meet your needs better. And so those people have started to go back to work. So that now they say on a national basis, the labor participation rate has come back up again. But we're not seeing people go into offices. So don't expect it. We've already proven that's not going to happen.
Yeah.
If you serviced people in offices, like maybe you were a dry cleaner that was in a building and you like to service people that drop off in the morning, pick up in the evening, that kind of a thing. Well, you have to say, no, probably not going to be a good model going forward. I'm
Yeah.
going to have a model with takeout, or I'm sorry, where I deliver, I pick up and deliver. As you said, if I wanted to have a sandwich shop, I could depend on people coming in and having a sandwich and a cup of coffee. Well, I don't know. Probably going to have
Yeah.
to do depend a lot
Have you
more
heard
on
of
that.
a coffee company called Blank Street Coffee?
I haven't.
So obviously Starbucks has, I forget how many stores in, I think 33,000 across the US. There's a company that I like called BlackRock Coffee that has about, at the time I looked last year, about 120 stores. And they probably have about 200 by now. But there's a company based out of New York City called Blank Street Coffee that has been growing like wildfire. They now have 150 places where they sell this coffee. And what's different about them is, you think about Starbucks, they have these $8,000 machines, right? That people go
Mhm.
and baristas make the coffee, and there's all kinds of incarnations. You can have soy this and oat milk that, and this is just crazy, right? So they use technology, but they're people. And so Blank Street, they kind of flipped it around, and they're actually a technology company that happens to make coffee. Their
Okay.
machine is $50,000. Seriously, you push a button and it spits out the product, and it's high quality. I mean, they're spending a lot of money on the technology side, and their claim to fame is that you can have a better interaction with the barista. They can say, "Hey, what's your name, Adam? Hey, how's your day going? What's going on?" And so they build this little rapport. But I'm thinking that one of the other steps they're going to make is they're going to actually have these freestanding places where you can get really high quality coffee, like in a vending machine. But we'll talk about that later. I just thought that was interesting. I heard this morning about that brand.
Well, no, it makes a lot of sense because you say, what are people looking for today? And honestly, the variations that Starbucks offered are not interesting to me. I find that most of the variations add a tremendous amount of calories to the drink, and I don't enjoy that. It's my lifestyle. I need the fewest calories I can get, but I do like some variation in my coffee. And I do know that if you have one of those really high-end computerized machines, you can take the same coffee and by altering the pressure, altering the water, uh, just a few alterations in it, you can have the same amount of coffee, the same grind, the same bean, same amount, taste different, right?
Yeah.
And so now if the barista starts saying, well, Adam, your taste, it runs more towards a little bit bitter, you like a little this or that, then he can program up the machine and get, I can have Adam's coffee. That
Yeah.
would make me a dedicated customer to go
Yeah.
in, right? So that's exactly what I think we're trying to say here is that you could depend if you were in the right location in Starbucks, it would be in the right location and I'll get a line out the door. And people all come in and they have their lingo they use to order that coffee. But that's going to continue. I mean, I wouldn't want to be running Starbucks these days
No.
for that reason, you know. But I would do love this idea that you're saying about personalization because that does fit. If I'm a gig worker
Exactly.
and I'm out there working, I'm like, hey, I want to go get a cup of coffee. I would go somewhere where they said, "Oh, you're Adam. Okay, yeah, Adam. Oh, well, we see this is what you like. What's the same as you usually get, or would you like something else? Or how can I help you today?" Right, and really customize up that coffee. I think that's a great idea. There was another company that I came across this week that they actually are out of Chicago. And what they do is they take and they make salads and healthy type products, but salads are the dominant one. And they put all the ingredients of the salad in a jar, and then they have vending machines. And they go out now. They monitor every single vending machine that they have in the country. One of their big places is airports, where it's hard to get healthy food and it's also very expensive. And so they put the vending machine in. They monitor the consumption of products. They have algorithms that try to do predictions, and then they go to every vending machine every single day. They take the old jars out, so they have multiple salads, and they put the new jars in. Then you can come up and you can put your credit card up to the machine, and you can say you want this salad, and the salad comes out of the jar, and then you have a choice. They showed how you could either, because all the ingredients are in the jar, you could loosen make the dressing, freshen it up, and shake the jar, and you can eat the salad right out of the jar. Or you could they have these paper, like the old fashioned thing that paper things that French fries used to come in, and you could put the salad in there, and you could pour the dressing on top and eat it. And what they're appealing to is people on the go, right? They're saying, "Oh, I want something simple. I want a nice salad." I'm sorry, I don't think of Subway when I think of salad, right? If I want something, and so they're trying to appeal to that same thing. It's the individual working asynchronously, gig worker on the
Yeah.
go, people not in the office. How do I try to take care of them? So I think again, what we're trying to say is that this commercial real estate consumption rate going down creates things we have to pay attention to. And if
Hmm.
it's going to affect your current business, how is it going to be negative? Or can you turn it into an opportunity? And how
Yeah.
could you make that into an opportunity? But I do think that we have to be very, very aware of the fact that we just have way too much retail space and way too much commercial space out there. And at the same time, we have a housing crisis, which is kind of insane.
Yeah,
uh,
it's crazy. So
yeah,
speaking of that, let's talk. Let's kind of shift downshift here and talk about how the banking industry is going to deal with the commercial retail or real estate space. I mean,
yeah,
they're tied very tightly together, right? Usually,
yeah,
if you're buying a piece of real estate, commercial real estate, you're not paying cash. And
right.
so let's talk about that.
Maybe putting 5 to 20% down at most. And in that space, you would typically there's one place where the regional banks are very strong as opposed to the national banks like the J.P. Morgan, Chase, and the Bank of Americas and the Wells Fargo's. The regional banks tended to play a lot in that world, and so you'd say I want to build an office building, I want to go for 10-year leases, and so consequently I'm going to go borrow the money. Well, recently, if you just go back before Jerome Powell, the killer of all killers. If you go back before that, then you had zero interest rates, right? So I'd say, man, I'm in the real estate game. I want to put this building up as my collateral, and I could get a very, very low rate. You wouldn't get zero, but it was really, really low. The problem was that the people on the other side said, you know what? Um, we're not going to give you that rate on a 20-year loan.
Yeah.
We'll amortize it on 20 years, but hey, I'm not going to promise you that rate. I'm going to make some money down the road. And I'm sure rates will come up a little bit. So what happened was you borrow, but they would only give you like 2, 3, 4, 5 years on the term on the loan. Well, what that means is that in the United States alone, we're going to have more than 25% of all the commercial real estate in the country is going to come up for renewal on their mortgages. Over 20%. It is calculated by the Federal Reserve to be $1.5 trillion of
Wow.
loans that are going to come up on the commercial real estate. These loans were offered at very, very low interest rates, and they were typically done at anywhere from 95 to 85% of the valuation of the building. Now let's back that up into kind of what this means. Say that what we now have that based upon all we're talking about with the real estate, okay, and how people aren't using the real estate.
Okay.
Commercial real estate prices are down 15% this year. Okay, 15%.
Okay.
Now they're projected in the next 18 months to decline 40%. So from the start point, they're down 15. They're expected to go down another 25 or 40%. Well, okay, if I go in and I say, okay, I want to refinance my building, and somebody says, well, the building's only worth 85% of what it was worth before. Oh, and by the way, your interest rate's going to go from say 2.5 or 3% to 8%. What happens is now the cost of the loan and the depreciation of the building means that the loan doesn't stand up anymore.
Mm-hmm.
All lenders want to have the income from the building. The target rate is that if you're a lender, you say, I want the cash flow from that building to be 10% of the mortgage every year. Now they're not taking all of that, but they're looking and saying, okay, we got to have some money for investors. We got to have money for the salespeople. We got to have all these other objectives. So consequently, what I want, it's kind of like the 10% is kind of like when they would say, well, if you've got a house, your total, you can only pay 25% of your take home pay into a mortgage.
Right.
That's what they're trying to do. And it's 10% for these office buildings. But the reality is that 50% utilization, they can't make it. Right? So we're seeing all this equity get wiped out. Now, this equity, in case of commercial real estate, it isn't a lot of entrepreneurs. Entrepreneurs do own commercial real estate. I don't want to back off that. But I will say that when we get to the really big dollars, we're talking about pension funds and BlackRock and these large organizations that put up literally billions of dollars that go into these loans, right? But they're not going, I'm sorry, they're not the lenders often. They're the equity holders. Well, now what happens is you sit there and say, okay, I got a building. I can't even come close to making 10% of the mortgage on it.
Mm-hmm.
Real estate prices have gone down 15, 20, 25, 30%. What you do is you turn to the lender and you say, hey, here's the keys, dude. You got the building. You own it.
Yeah.
But the problem is that doesn't fix the problem. So now what happens is the equity holder's been wiped out. So all of you that are investors in commercial real estate trusts, REITs, listen, because we saw the retail hammer. Now we're going to see the commercial hammer. All right. I wouldn't want to be in that space, folks. If you don't see it coming, open your eyes. But the second thing is the banks are going to be sitting there saying, we've got buildings now that are worth less than what the loan was. So now I have to write that loan off. That's the same problem we've had recently where they had to write off these treasury bonds that they bought that had 2% or very, very low interest rates. And now the interest has gone up, the bond value has gone down. They had to write it off and it wiped out their equity. That's what we saw at Signature Bank. It's what we saw at Silicon Valley Bank.
Mm-hmm.
So we saw this get wiped out. Well, the next wave is going to be on these commercial loans. JP Morgan Chase, the analyst there, said that 20%, the projection is 20% of all commercial real estate loans will go bad. 20% will
By
go
what
bad.
date?
In the next 3 years. This is at $1.5 trillion of loans coming up in the next 3 years. They expect to write down 40%. So 40% of 1.5 trillion is $600 billion that the banks will be writing off in the next 3 years. There was a senator from Illinois that they claim, and nobody knows, he never really said it, but he just got lucky. He claimed to have said in the Senate one day, $1 billion here, $1 billion there, and pretty soon it all adds up to real money. And certainly I would say that people should pay attention to the banks writing off $600 billion worth of loans. So what does that mean? Well, that means if you're a small business person, first of all, let's go kind of back this up. About 2-3 years ago, Manny, do you remember we had a really bright young fellow on their show, and he made beer, and he talked about how he grew his craft brewing company.
Yeah, my buddy Ben. Yeah, I go to
Yeah,
that brewery all the time.
and he'd made some good
Vacancy.
decisions. Like he didn't get into doing food. Instead, he let the place next door do food, and they could bring it in and do it in his craft beer shop. And one of the questions he was pondering at the time was whether or not he should go for a long term lease, get a different building, right? And we advised him at the time. We said, look, based upon trends, short term lease, short term, because rents will go down. And so I'm hoping Ben took our advice at that time, because rents for what he does should be down in Tucson, and he should be able to take advantage of that for the next 2 years. Now, we always have microeconomy issues, and so the economy in Tucson may be doing better than the national average. It could be different, but the reality is the first thing is, if you're a business person out there, don't be going out on any long-term leases these days, even if the rate looks really good, because it's going to continue to go down. We're going to continue to have opportunities that are going to come along. If you're thinking about expanding your business, that's great. But realize you're not in a position where the landlords can dictate to you what's going on, because you're going to be able to strike a deal. Just
Hmm.
be willing to argue for it, right? Get out there and make your case and force them to come down on the price as far as you can. Because these people are going to be desperate. They're going to be desperate to
Yeah.
find a use for the building. Now so that's the business decision we can make. I think that this will probably affect the Federal Reserve. They darn near killed our economic prospects already with what they've done. Two important banks have been gone out of business, and a few other smaller banks. If they don't see this as the threat that it is, that I can't even hope that Jerome Powell will ever get eyeballs. But I think it will cause them to stop raising interest rates. I think if we wipe off
Let's
six
hope.
hundred billion well, $600 billion of equity, that's going to be a massive hit to the economy. That's extraordinarily deflationary, right?
Yeah.
And so we've got to make up for that. The only way you make up for deflation is by more dollars, which means lower interest rates that you're going to have. So in the process of killing inflation, we could well be creating deflation, which would cause that recession that I keep saying I don't think we can avoid. So
Yeah.
being prepared for a recession would be good. Being prepared for lots of real estate being available would be good. Now, another piece that I think is important here is zoning. People that build houses and build retail space and build commercial office buildings build what they're allowed to build. The city of Tucson, city of Phoenix, the city of Las Vegas, all of the cities out there have zoning rules. Houston's are some of the most liberal, and places like San Francisco are some of the most strict. But part of the reason we have so much commercial space, well, not part, the reason we have it is because some city planning people said, this is what we're going to do, and we're going to build this. This will be commercial, and this will be
Yeah.
residential. Well, now we're going to have to do something about that. We have to do some zoning changes. We're going to have to say these commercial buildings don't have a use. There's no fair use. Can we convert those into something more usable? Now, everything I read is that when you build a commercial office building, it is just not designed to be something you live in.
Not
The
really.
bathrooms
No.
layout, everything's not really designed for it. But we're going to probably have to do that. We're going to have to start saying, well, we have to put the investment in. If you look around our country, there is no major city I go to that I don't see homeless people. None. I visit wonderful Tucson. There's homeless people. Nobody can avoid it, right? So here, on the one hand, we have what we call a housing shortage. I have a son that's 32 years old, and he can't afford to buy a house, even though he has a PhD. And he talks about real estate being too expensive. Um, and then we have people living on the streets. Well, we have a housing shortage. We can confront that if we realize that some of this retail space and some of this commercial space needs to
Mhm.
be converted. But that conversion, we can't sit there and say that's a market opportunity, because there's no developer that can go out and do those conversions unless the zoning changes.
Yeah.
Somebody has to say that was zoned retail. We can now zone it residential, and then somebody can come in there and make a plan and try to get that conversion. So for most of us in business today, it's important that we start really at the local level, start really arguing for this rezoning to start happening, and happening quickly. We need to be able to say, if there's a multi-use facility, let's get it zoned off for residential.
Yeah.
Um,
I think we've talked
Chicago,
about this in the past, how the government is, in my opinion, needs to step up and work with these zoning issues. We've talked about immigration issues, where if we were to be more open with our borders in a very specific way, we could have capitalized on lots of people that are looking to advance their career and their professional life and so forth. And I don't know. I mean, I don't like dealing with the government very much. I think nobody really does. And I'm certainly not a politician. I have friends that are, and I don't understand why they would actually go forth and do that. But I think there's got to be some eye-opening conversations happening in the next, 2, 3, 4, 5 years as we're dealing and facing with these issues.
Well, I know that our listeners probably don't talk to their congressperson or their senator at all. Most of us don't. The rare exceptional time I've had a conversation with one, it was almost by accident, rather than being, hey, I want to talk to you because I got a problem. But what we often do have much better relationship with is the representatives we have at the state level, our congresspeople at the state level, our county commissioners, our local commissioners. We have a much stronger relationship. And we've certainly seen a lot of people be very active in school boards over the last few years. But take some of that energy and start saying, wait a minute, if I've got some homeless people in my town, what could I do? Could we work with people to get the zoning rules changed, to get a developer involved, and see if we couldn't come up with some low-cost housing for homeless. Now, everybody says, well, homeless people are there because of mental health issues and drug addiction, and that is part of the issue. But it's not the whole issue. There are people who just can't afford it, people who got displaced. Something went wrong in their lives. They ended up out and about. There's untold numbers of marriages that didn't survive for often abusive husbands, things like that. And a woman and a child end up, living in their car. They don't want to be homeless. We could help them if we change the zoning. We get the developers in there. We could really start to tackle the zoning problem. We could take some of these facilities that are commercial buildings and turn them into units for drug treatment, turn them into facilities that could be used for mental health, right? Now's a great time to do that. We've ignored these problems a lot in our country. We try to say that they're individual problems. They're up to the individual to solve. We don't try to step in there and do much. But hey, if the real estate's there and the real estate's going to be very, very affordable, and we zone it so that some developer can say, hey, I could probably turn this into a usable space for this. And then you tend to, this is one of those situations where then you'll tend to get somebody to say, hey, I'm a physician. I'm in the mental health world. Yeah, let's put a clinic together. I'll come in there and run a clinic. Or somebody would say, yeah, I'm all up for taking and creating multifamily dwellings. I recently heard a statistic that just blew me away. California has the biggest homeless problem in the United States, but over 90% of all the zoned residential space in California is zoned single family. This is apparently part of the history of the state going way back. They like the idea of single family homes. So everybody having their own individual small single family house. And if you think about it, when you drive through many of the areas around Los Angeles and Fresno and San Francisco Bay Area, you see these communities, you drive them down just row after row of these individual small houses. And you see a lot of mobile home parks, right? Trailer parks, as we call them in Oklahoma. You see a lot of them. Why? Well, because the zoning demanded that it had to be single family dwellings. Well, it's time to rethink that, right? It's to say, come on, let's get people in these multifamily dwellings. We can build them from scratch. But if we got empty retail space, is one that that's not.
There's a lot of things we can be doing, and I think that this conversation is going to open some doors, hopefully, and some thinking of just having people rethink the way that they're doing business and rethinking how they're going to grow and what sort of businesses they should be working on. So what kind of final thoughts do you have for us, Adam, before we log off for today?
Well, again, this all started by thinking about millennials and Gen Z and what is it they want from the workforce. And what I'm trying to make sure our listeners get to this is start unpeeling what that means. What is the impact? So the impact 1, impact level 2, impact level 3. And that's how we build our scenarios. And then once you've got a scenario, you can really look around and say, what are my threats and what are my real opportunities? Don't look inward. Don't look at the competitor you've talked about for the last 10 years. Look at the world. Look at the market, look at how things are changing, and then start peeling the onion yourself, get these insights, and then change your investment profile and how you make your decisions.
Very well said, Adam. We'll talk with you next week, and until then, cheers.
Thank you, Manny.